Do you view it as hot, or parts of it are hot? Kyle, you're with Hayman Capital Management, founder and chief executive officer. Good or bad news?
Well, I mean, when you have inflationary recessions, which is where we are, employment is the lagging indicator. It's the last thing to turn, and it normally turns 6 to 10 months in. And so I think we're all focused truly on the wrong indicator. It's a little hot, but the number of job openings dropped pretty materially in August, and I think that also happened in September. So, I know the markets don't like this, and I know the Fed's going to keep hiking, but I think we're focused on the wrong indicator.
Okay. At this point, how many more basis points in your view, Kyle? I mean, given that maybe they're looking at lagging indicators and everything else, we just heard they've made zero headway getting to 2% inflation. So what are they going to need?
So look, my own view is you think about the balance sheet. The Fed's balance sheet pre-global financial crisis was $900 billion. The Fed's balance sheet post-crisis, pre-COVID, was $4.1 trillion. That balance sheet during COVID went from $4.1 trillion to $8.8 trillion. They're just now beginning to pull almost $100 billion a month off that balance sheet. I think they're hoping to get $1 trillion off the balance sheet before they have to stop. I don't think they'll get $1 trillion off that balance sheet before they have to stop. So I still hold that we'll be seeing a pause in rate cuts a little more than a year from now.
So have to stop instead of being able to stop because they gently land us at lower inflation levels. What's going to cause them to stop? What kind of dislocation?
I mean, look, Europe's going to have an aggressive recession. Asia looks like it's in a recession. The dollar's strong, and the U.S. is already in a recession. We just keep hiking into, when you look at real GDP, we're already in a recession. I know the White House has tried to redefine the definition, but in reality, when you look at the CEO survey, that CEO survey is about as bad as it gets. You have 54% of CEOs believe that the recession won't be short, that it'll be longer than people think it is. And the overwhelming majority of CEOs believe that we're in a recession. And so I think it's important to note that what drove our inflation, Joe, wasn't necessarily only rates, right? It was the fact that we put 40% more money into the money supply in 18 months. And we're just now starting to make that money supply contract. And that's the real thing that the Fed needs to focus on. I don't think rates are what they should be focusing on. However, the mechanism of the rates getting into the market, call it 9 to 12 months from now. Mortgages are over 7%. For a while, they were right at 3%. We've had a 400 basis point move in mortgage rates. You're going to see the economy hit the brakes hard when the numbers start coming out from the lags.
Shepard Smith here. Thanks for watching CNBC on YouTube.